Good evening, everyone. I am Prateek and I lead the research team for MarketSmith as well as swing trader at William O'Neill India. So, if anyone from SRCC has joined us who is in the management committee who is managing this event, kindly ping me in personal chat once. In the meanwhile, I request all of you to kindly be on mute mode as well as turn off your webcam. Also, ping me if you are audible because I won't know whether you are audible or not. If you are able to hear me, kindly ping me in the chat box. All right, so I can see that most of the people are able to hear me. So before I start further, I would like to ask like how many of you who have joined us today are into the investing and how many of you have heard about William O'Neill, the legendary investor or CanSlim investment strategy? So again, you can either respond by raising your hand or maybe by pinging on chat box because it will help me knowing to know to whom to what kind of people I'm addressing to, and it accordingly I can go with the concepts which we will be discussing today. Great. So I have received a couple of. Okay, great. I've been okay. So a lot of couple of you have heard about it. So okay. So this event is specifically by SRCC. However, we wanted to intervene into this because since, as you must be knowing, that we might give an internship opportunity to the winning team. So we want to train all the participants because preparing just a stock pitch, if we give you an XYZ stock and ask you to prepare a pitch, it would have been very unfair because what we are looking for and what you would have prepared would have been very different because it's pretty easy to prepare a stock pitch. You can a lot of people do it. They do a lot of due diligence about the company. A lot of people just Google search and just kind of aggregate all the data and send it. So what we want is so this entire event will be taking form in the form of a training. So this will be the first webinar where we will discuss the canceling strategy, the common pitfalls of traditional investing, and after that you will yourself know if you are into the investment that a lot of mistakes which you have been doing till now. After that, we would like to know, like say for example, we'll tell you the buying and selling strategies. We will also give you the sectors which are about to perform good or which are performing good in the Indian markets. You can also select your own sectors. Post that, we want you to pick any four stocks from the sectors, or say or it could be generic also, and you need to prepare a pitch based on the canceling investment methodology. So I will be discussing the this strategy today. If you have any questions, you are free to reach out to us. All of you will be assigned a mentor from MarketSmith, so you can mail to your mentors about your queries. Uh, if you have any queries regarding, say, you are not through with the concept, or you don't know where to pick the data from, everything you will be able to, you can ask them. And for any queries regarding this particular webinar, kindly post it in the chat box. I'll be happy to take it as and when it is there. So this is a disclaimer slide which says that all the content and the examples which we will be discussing today should not be taken as our recommendation to buy or sell. It's just for educational purpose, and in no way should be considered as our advice. Please don't go and buy those stocks, because we would be taking examples of past. That particular stock might not be good right now to buy. So please don't buy those stocks. So in today's webinar, we will discuss about the importance of investing, the right approach, and the rules to follow. This section 4 and 5 we will discuss on 7th, the second webinar which we have with you. During that time, we will also discuss the buy and sell strategies. So today, mostly we'll discuss the CAN-SLIM, what is CAN-SLIM, and what is investment. So I presume that most of you would be through. I'll talk about compounding and all those things, which I am pretty sure that I've seen the profile of most of you, so you would be knowing all those concepts. So I'll just brief through about them, and I'll go into details when I talk about CAN-SLIM. In the meanwhile, if you have any queries, feel free to post in the chat box. I might not answer that during that time, but I'll take it towards the end of the webinar. So as we all know that what's the importance of investing? Basically, it's an inflation hedge. You all know in this chart, you can see how Sensex has grown, FD has grown, as well as inflation has gone up for the last say 20 years roughly. So over the last 20 to 30 years, if you see, Sensex has gone from 0 to 35,000 levels. It's trading at above around approximately 35,000. FD has given you, and if you would have invested in a bank FD in 1990s, you would have received somewhere around 8,000, 8,500 rupees. Whether so, and your inflation has gone up nearly from 0 to 5,000. I mean, it stands at 5,000 today. So almost that's where investment is important, because if you don't invest, you would not be able to. Your expenditure will increase. You will not be able to sustain those expenditures. So that's where investment is important. I'm pretty sure you. I don't need to describe all these things. You would be knowing it. So I'll just quickly sum it up. This is a chart which says that if you would have invested in Infosys in 1993, in June 1993, and we have taken the data till October 2017. So 10,000 rupees invested became roughly 3 CR, and CAGR was 40%. So multiplied by roughly almost 3,000 times. So the similarly some, and these are the names of some good quality stocks. Some top stocks which are still till now, these stocks, some of these stocks are very good stock, which a lot of funds, even we are holding it in our funds. So that's identifying these kind of key stocks is important. And second thing is patience. You need to be patient to hold the stocks for long term. Having said that, you should have a sell rule. And as we go forward, as you go forward with us over the next 15 days, you will learn why and how selling is more important than buying. You can buy a stock like from any. You just go to Money Control. You will see a lot of broker houses, lot of investment banks will give you a stock idea to buy a stock, but very few will tell you when to sell a stock. With CAN-SLIM, with O'Neill's methodology, we focus equally on buying as well as selling. So our sell rules are very important, and it has to be followed strictly. I'll discuss about the sell rules as I will discuss the CAN-SLIM. See, during that particular point of time, the IPO used to be worth 10 rupees. So it used to be like, it depends whether a company is a blue chip or not. It depends on the market capitalization as well as the growth of the company. So ideally, Infosys, Imami, Eicher Motors, they all came up with an IPO. That time there was a rule, you have to come up with an IPO at face value, 10 rupees stocks. So I'm not aware of the market cap that time. However, so this concept of blue chips came in kind of after 95, 2000 only, when we had a good run in the year. I'll show you that the phases of bull run in the Indian market. Okay, so this is the chart. So the point is that if Sensex has given you so much of returns in 30, it went from 0 to 35,000 in the last 30 years. Was it that easy to earn returns? That's the main question, because it's very difficult to block your capital for 30 years. Even if we say that we are a long-term investor, so there must be a definition of long-term. Because you might see that you bought a stock, you hold it for 7 to 8 years, you got a return of say 80 or 90%. It became 80, it gave, or maybe it went up till say it gave you a return of 200%, so 2x. However, if your timing of entering that particular stock is good, you would have made most of those 200% in a very short span of time. So in CanSlim investment, in CanSlim strategy, we also teach our investors, our users, and I will be teaching you guys how to time the market. Even now, if you are following the market, you don't know whether you are in a bear market or a bull market or it's a sideways market. To be honest, no one knows it. But William O'Neill has found a strategy where he is more often than not correct in timing the market. So we have segregated the market into four directions. The first one is the confirmed uptrend or rally. That's your clear-cut bull market, and we say that it is the best time to buy stocks. Once the market condition is degraded from rally, it goes into a volatile situation which is called uptrend under pressure. So during this time, we go for profit booking. So the stocks in which we have made profits, or in the stocks in which we have say incurred losses, we go for profit booking during that time, and our approach is a bit conservative. But from here, if the market is degraded, it goes to correction. Now correction is the time where we advise, or rather we in our fund will sit at cash. The reason being, 75% of the stocks will follow the market direction. So if you are planning to buy the stocks when the market is in correction, the odds might not be in your favor. It's rather you should use your time in identifying those 25% of the stocks which are going against the market. And if you are able to identify that stock which is showing that kind of a technical and fundamental strength, it's go ahead with that stock. After correction, that's the bottom. Now from here, everyone wants to know that when to do bottom fishing, because even in 2018, and I have been receiving a lot of questions, like say for in the month of August, in 2018, August was one of the months where Nifty gave a very good return. So in the month of August, people thought that it's a good time to do a bottom fishing. Someone who would have entered and or who would have done bottom fishing in the month of August would have, they would have eroded their capital badly till now, till date. So that is the reason we say that it's not easy to do bottom fishing. However, we have a concept, or we have a market status where you can kind of look to catch the fish when it is, when it's basically trading at a bottom. When the stock is trading at it's bottomed out or it's reversing its trend, there is a bearish trend reversal. So that when the market is upgraded from correction, it goes into rally attempt. Now rally attempt is a phase in between bear and bull market. So during rally attempt, you will see when the market status has been changed to rally attempt. During that time, you will see a lot of false signal that market is into the bull, and you will get into the market. And on the second day, you will see stocks would fall, like say 7-8%, Nifty falling by 1.5%. Now during rally attempt, there is a concept of called follow through day, and once we get that follow through day, we change the market status, upgrade it to rally again. Now follow through day is the day when Nifty will trade more than 1.5 or 1, we will basically gain by 1.5 or 1.75% on the volumes higher than its previous day's trading session. So say for example, currently we are in a rally attempt market, and today Nifty ended say with a gains of 1.8%. Now what we need to check is, we need to check yesterday's volume and today's volume. We need to compare both. If the volumes are higher today, in that case today will be called a follow through day, and we will change the market status into bull market, that is confirmed uptrend. One thing I would like to just give you as a matter of fact, that no bull market in the world has ever started without a follow through day. So when I was discussing this market status, there is a question in your mind that how do we identify that? Now, for identifying this market direction, we have a calculation called distribution day. And I will repeat what is a distribution day. Distribution day is basically when the Nifty falls by 0.2% or more, again on volumes higher than its previous day's volume. So say for example, again Nifty fell today by 0.28% and the volumes were higher than yesterday's. That is Thursday's volume. It was higher in today's volume was higher compared to yesterday. So in that case, today will be called as distribution day 1. Now, when you are in confirmed uptrend and you see that in during this confirmed uptrend phase, the distribution day mounts to say 5. In that case, you will degrade the market to from confirmed uptrend to uptrend under pressure. So this distribution day expires in every 25 days. So it's a trailing 25 days concept. So the distribution day which occurred on the first trading session will expire on the 25th day. So 25th day. So now I would just give you a sense of it. You are saying that you are in a bull market. However, over the last 25 trading session, you got 5 distribution days. That means on 5 occasions, Nifty were 0.2% or down. That doesn't look so good, right? If you are into a bull market, more often than not, even in 90% cases, the Nifty should close above, say, in a positive, or the the losses should be very humble. So that's not coinciding with the market direction. So market will be changed to confirm uptrend under pressure from confirmed uptrend, so degraded. Now from here, if you again see 2 more distribution day, now that means when the distribution day is 7 in the last 25 trading session and the Nifty has breached any of its key support. With key support we mean 50-day moving average or 200-day moving average. So if Nifty breaches that and your distribution day count adds to 7, here the market will be moved into correction. So when I'm saying all these things, I must give you the current market direction. Currently, market is in uptrend under pressure. So we have changed the market into uptrend under pressure 2 weeks back, and we have a distribution day of 4. So if one more distribution day is added, and or else Nifty is trading very close to its 50-day moving average. If it reaches 50-day moving average, in that case Nifty will be trading below its 200-day moving average and 50-day moving average, and we will change the market into correction. So we hope that it doesn't happen, because you have your competition in the next say 20 days, and if the market is in correction, most of the stocks which you will pick up, or say most of the which you will be prepared, will be kind of very biased, because most of the stocks would be falling. You might see a stock picking up, because once the market is in correction, 75% of the stocks will follow the market direction. So these all calculations are there, which if you have any doubt, ask us. We will discuss it again on 7th, because I know it's it's very heavy when I'm saying it on the webinar. So we will send you, if you have once you have been assigned the mentor, you can mail it to them. They will come up with the answers. They'll give you the answers in a written format. You can rethink, relook, and in our Market Smith India app, you can check historically when we change the market status and how Nifty performed during that time. So you can go and check during that in our Market Smith India app. Okay, so from this slide, I would like to basically, what we meant is that the timing is very important. And we being a growth investors, another thing which I missed saying, CanSlim is a growth strategy. You must be knowing about there are 2 methods of investing. One is called value investing. Second is growth. The third is growth with you have GARP and other methods also, but it all comes under growth and value. So we are a growth investor, and we follow growth with momentum. So when I say that, that we look for stocks which has high P, and that's where we are different from the conventional approach, and I will discuss the conventional approaches versus the Market Smith India approach. Basically, when I say Market Smith India approach, I talk about CanSlim strategy, O'Neill's methodology, as well as growth strategy. So conventional wisdom says that buy low and sell high, and buy on the dips. Now this is something we totally ignore. We buy high and sell. We believe in the concept of buying high and selling higher, buy on the way up and not down. Now, when I say this buy on the way up and not down, basically what I'm trying to say is never ever average down in your life. If you are averaging down a stock, you're doing the biggest mistake. And if you just go back to your personal investment, you would have seen that if you are continuously averaging down a stock, when a stock is, say you bought a stock at 100, fell to 80, you are averaging down. Again, it fell to 60, you are averaging down. What you are doing is basically you are buying, adding your positions into that stock where the quality has go down, where none of the funds, mutual funds or foreign investors or domestic institutional investors are interested in that stock. Because in India or anywhere in the world, market is driven by institutional investors, whether be it domestic uh, or foreign investors. And fortunately in canceling, we have a we basically check this I. That I in canceling stands for institutional sponsorship. So make sure the stock which you are picking up should be held by institutional investors, be it foreign or be it Indian. It should be held by them, because these institutional investors give support. What I mean support is when the stock is falling down, they buy the stocks at key support levels. That is your 50-day moving average or 200-day moving average. And I will show you a lot of examples. Even after we are done, you will have my email IDs. You can anytime feel free to ask me all those questions. I'll show you with a lot of examples how support is being given just by looking at the charts. Though you can get the numbers from a MarketSmith India app, however, even if you don't require a number for knowing whether institutions are giving support or not, you can just check it through charts. So our concept is buy high, sell higher, and there is a very basic economics behind it. Stock is nothing. I mean, stock is simply like any other commodity. For any commodity, if there is a demand, the prices will go up. The same goes for stock market, for the securities. If there is a demand for the security, the price will go up. And if the prices are going down, that means the growth story is over, and the stock is, the people are dumping the stock. There is no demand. So don't think that the stock is some XYZ. You know about TCS. You have been hearing about TCS for the last 4 to 5 years. You bought TCS when the growth story is over. So that kind of a concept is wrong. And this average down concept, I will tell you, we also do average down, but how to do average down, there is a method of averaging down. So what you have been hearing is a normal average down, but how to do average down, we will teach you. Normally you should average down at key support levels if you're seeing the support over there. So we'll check it in through the chart. Okay, so we have a question that how do we know that this stock is holded by institutional investor? Okay, so I request all of you to kindly post the questions publicly. Don't post any questions privately to me, because since this is a common one, when you have a webinar with your, say for example, when all the mentors will be there in the webinar, during that time you can privately ask the questions, because I know you don't want your, say any of your strategy to be revealed by your competitor. We understand that, but currently it's a generic canceling webinar. If you have any questions, kindly post it in public so that everyone get to learn from that. Okay, so so the question is, how do we know that that a particular stock is holded by institutional investor? Now there are 2-3 places where you can check it. First is in our MarketSmith India app. In the evaluation tab, you will see that what's the percentage increase in the number of shares, in the number of funds. It will give you the number. Now, if you want to know the name, the second place you can go is, you can go to the NSC's website. Over there, you will see the holdings. For a particular, you just type the name of the stock. In the holdings, you would get to know the name of the institutional investors, because those are the investors who are holding 1% or more of the company's shares. So there you will get the list. Or the third place is in the company's annual report. They also disclose the top, top fund, I mean, people who are holding more than 1% of the stake in the company. They have to give that data. So over there also you can get it. So 3 places are there where publicly you can get those numbers. So as I told you that why we say to buy high and sell higher is because it's next to impossible to spot the bottom, and simple math shows that it's easy to get trapped, because You bought a stock at 100 rupees, it fell down to 20, you are still buying, it fell down to 60, you're still buying. So a 100 rupees stock you bought thinking that you would make 20-30% out of it. However, it fell down to 80, you did not cut your losses short at 8%. So, your stock fell to 20. Now you need 25% gains to break even. Now you are expecting a 25% gain from a stock which is already in a downtrend, which is kind of impossible you're expecting. So, and I just mentioned 8% stop loss. That's one of our sell rule. Always cut your losses short at 8%. And that you might think that, it sounds as if it's a very retail, it's a rule which is pointed to retail investors, but trust me, that's the rule which we have been following, and or all of the institutional clients we support, this is the key rule. Cut your losses short at 8%. No matter what, book loss, just sell the stock at 8% loss. If there is a reversal in the stock, we would buy it again. But no matter what, you don't know when the stock is falling what is the main reason. You might be thinking that there is a negative news about the stock, or there is a earnings, on a downside there is an earnings surprise, a dip in the earnings. The street was expecting 40% revenue growth, but if there was a 20% growth, just sell the stock when it hit 8%. First thing you should do is sell the stock during that time. Then do your research, see what's wrong with the stock, why is it falling. If you think that fundamentally there is no problem technically, however it is breaching key support levels, in that case again, always remember that charts tells you a lot of the story which the company's balance sheet will never tell you. I will show you that. I will show you some examples. I don't know whether it has been included in this slides or not. However, you can mail me up in I'll share my email ID. You can mail me up. I'll show you right before earnings, this quarterly earnings date, you will see stock falling on above average volume. Now above average, buying on above average volume or selling on above average volume is a signal of technical weakness. That means institutions are coming out of the stock. So, right, your earnings is due on say 25th of February. Right from 20th February on say 20, 21st, 22nd, you see stock is just falling down on above average volumes, and you hit 8% stop loss. Just sell the stock, because 90% of the time you will see on 25th the earnings will be very disappointing and stock will open gap down. So charts will actually tell you the weakness well in advance. If there is a fundamental weakness, you will come to know through charts. So that's the reason we give 20% importance to technicals in our analysis. CanSlim is 80% fundamentals and 20% technicals. I saw someone just mentioning that it's a technical analysis. That's wrong, because everywhere funds, all the fund managers, even we, when we buy stock, we check technicals because it's very important. And also a multi-bagger stock seldom tests its 200-day moving average unless the market is very weak. So all those things will help you in identifying or will support your case if you have picked a multi-bagger stock. Just check whether that stock has ever tested 200-day moving average or not. So all those things are there which just increases your conviction about the stock. Second thing, if you are not buying at a technically sweet spot, in that case, even a good quality stock might turn a laggard for you. You might buy that stock, it might fall down. On the other hand, an expert who picked up HDFC Bank will buy it at a technical sweet spot and will gain 20% out of it. So in 2018, the similar thing happened. The swing trading portfolio which we have, it's based on we shortlist fundamentally strong stocks. We have a very high filter for fundamentals. So those fundamentally strong stocks we picked up based on just technicals. So over there we generated a return of 41%, and Nifty just gave a return of 3%. Mid cap, small caps gave a negative return. Sensex gave a 6% return. So we have outperformed basically all the indexes heavily, and that's only because though that particular stock fell 40% in the year, but whenever it was rising, we were able to capture those gains. Those small gains we captured, and we generated a return of 41%. However, on the other hand, this market Smith portfolio, there though we check technicals, but we only check breakouts. We are not checking too much on moving averages. So that particular portfolio which we have in market Smith, that underperformed Nifty and Sensex. However, it outperformed the mid caps and small cap indexes, mainly because we were too much heavily weighted on mid caps and small cap stocks, right, towards the end of 2017. So we underperformed. We had a negative return of approximately 20% this year in markets with India. And the same portfolio outperformed the market last year. We generated a return close to 80%. So that's the stats to give you about the markets with India's portfolio. So now the third logic which says that which just to justify my case is, in a class if you would be asked to bet, you would definitely bet on the toppers, because there are high chances that those guys will again be in the top three, rather than betting on a student who is coming, who's coming, say, at a lower rank. So because the odds are not in your favor when you are betting in those students who are at the bottom of the bottom of the rank. So this is the reason we say this normal logic, this normal common sense can help you in knowing that why you should buy a stock when it is going up. And the second thing is, if you don't buy a growth stock at a high, at a P when it is at a P of say 40, 45, you will regret it when it expands to a P of say 80, 90. Growth stock will have a P expansion. You need to buy it at a high price and sell it at a higher price. So this is an example. This is a chart where someone who is fond of averaging down. So here I would show you. Now here I will also clarify the concept of institutional selling. So this particular stock topped at 939, 930, 927 levels. After that it fell to 591. So it's a chart of Bharat Financial. Now someone who would have averaged down, he would have bought it here, again at here, at here, at here. So just see that if you are kind of averaging down, you are averaging down till the stock, it came below, like it reached all the key support level of 591. Now the point is, you might ask me that this about this gain. It again came into the uptrend. Now there are strategies in canceling where we would enter again, but for the time being, what we would have done is, this is a 50-day moving average line, this blue line. This is a 200-day moving average line. Now, one of our sell rule, I have already told you that we sell the stock once it hits 8% from our buy point. The second sell rule is, if you see a stock is breaching its 50-day moving average on above average volume, sell the stock. Now, this horizontal line is called average line, and these are the volumes. These are the volumes, and these are the price actions. I told you that most of the buying and selling is done by institutional investors, and you can just see it, you can just sense it by looking at the chart. Now, in this particular chart, if you see, normally institutions would give support at 50-day moving average. If they want to hold the stock, they would average down over here, and this is what you called as actual averaging down. If institutions are averaging down here, the stock would have bounced back from here. However, the stock breached this level, and just see the corresponding volume. This is the average line, and this is it's falling on above average volume. That means that institutions are selling, and you can see on 1, 2, 3, 4 occasions institutions are selling. They have sold it a lot, and once it reaches 200-day moving average, there is another institution which is buying. Now you can see buying on above average volume. If you see something like this happening, you need to wait. See, there is a lot of buying and selling happening. We normally we also would have to see the market condition during this particular point of time. So this is how institutions play, and that's the reason we say that if you're buying a stock, make sure that institutions are holding that stock, because they tend to give support at key levels. At 591, the stock might be looking very cheap. It might be looking cheap to value investors. They would like to buy the stock. But see, we are a growth investors. We would have bought the stock at a strong breakout, say somewhat here. We would have exited over here. Now, a value investor buying at 591, 600 rupees will only see 756. It will take a lot of time to go up from 591 to 927. So, in the meanwhile, they'll wait for the stock to go again to 927. It will take 4-5 years, and we would have compounded 40% over the next 5 years in different stocks, and almost tripled our money. So that's how that's where the difference between a value investor and growth investors lies. I'm not saying that even I am a big fan of value investing as well as growth investing. I'm not saying that value investing is the wrong concept. Definitely, if your bet strikes in 1 year only, you can make 700, 800%. Like in this In the year 2018, we saw Dolat Capital, Dolat Investment, that stock went from 7 rupees to 56, almost 800%, 8 times. So if you are able to identify those stocks, well and good. But the main question is how many people are able to identify. Even with doing a month of financial modeling, coming up with a target, the point is that everything is based on assumptions and estimations. And if even you changes your estimate by 1%, your entire target is gone for a toss. And that's the reason we say that don't base your decisions based on P, because P is just a end result, and it's not a, it's not a something which should help you, which should be the main factor for identifying a stock. I'm not saying that denying price earnings ratio, it should be one of the factors, but not the most important factor. There are other factors which you need to look, and that is what I'll discuss in catch. Now this chart, just see that stock after breaching 200-day moving average, from here it just fell badly, and there were a lot of institutions selling happening. Okay, cool. I have got two questions. I'll like to take that. First is from Vinayak, who is asking that if we have a long-term view of say around 5 years, then why should we place the stop loss at 8%? Correct. See, the point is why we say 8% is I've shown you the example. So if you see the example of Bharat Inclusion, this particular stock, from 930 levels, if you don't cut your losses at 8%, or say for example, if when the stock is breaching its 50-day moving average, that is the second sell rule. If you're not following any of the sell rule, your 927 stock would become 480 rupees stock. So it's almost halved, and even if you are a long-term investor in the next 5 years, this particular, it's very difficult for this stock to again come back to 927. So what you are doing is you are just blocking your capital. And always remember, there is nothing called short term or long term in stock market. I am telling you from my personal experience. This swing trader portfolio which I have created in 2018 itself, seeing the general market direction. I have observed the bull bear market. I mean, when the market, I mean, I would say that in 2018 the market was definitely, it was not a bull market. We were kind of into the beginning phase of bear market, and that's the beauty of a bear market, that even when you are in the mid of a bear market, you will not realize that you are in a bear market. But according to me personally, a bear market is a market where it's difficult to make money, and 2018 has been one of those years where it was actually difficult for you to make money. You invest in any stocks, it was just falling down. So there is nothing called long term and short term in stock market. It's all about how smart you are in timing. You should know when to time a particular stock. If you are a long term investor, say if you have a long term view on Bharat Inclusion, what you could have done is you should have followed 8%. If you have identified the stock correctly, if all the research which you have done, which you have put the efforts are good enough, the stock will seldom falls 8%. Now this is being said by William O'Neill and not me. William O'Neill says that if you have identified a strong good quality calcium stock, it will seldom fall 8% from its pivot point. Now pivot point and all we will discuss. For the time being, just to answer your question, so mostly if you have identified a good quality calcium stock, it will not fall 8%. However, based on my experience, when I am running the portfolio, I have seen that when the market is in correction or in uptrend under pressure, stock do falls 8%, and we remove the stock. But if I am having a long-term view in that stock, what I do is once I sell it at 8%, if I see, I wait. Normally, if it falls 8%, it would take at least a quarter for the stock to show kind of a trend reversal, unless it's a support or resistance game technically. In that case, we might add it again when it pulls back from 50-day. However, I would like to wait for the next quarter. If the earnings are strong and I see that there is nothing wrong in the fundamentals of the stock, definitely I will add it again once the technical improves. However, technical weakness means selling the stock. So that's how we roll when we have a long-term view on a stock. So for 5 years, we might do a lot of buying and selling, but then we will not, increase our losses. Now this 8% is strictly for retail investors. In institutions, it might go up till 12%, and this 50-day moving average might go below 100-day moving average. The second question is, okay, I see that few people are saying that they are not able to listen. I think I would request all of you to kindly be okay. I could see some people just having their mic turned on. Kindly be on mute mode. It's a webinar. I hope you are able to hear now. Rahul, I hope you are able to hear now. Okay, so we have a question from Lakshya who is asking that it is difficult to find bottoms, it is difficult to find peak in case of growth investing too, right? I'm not saying that it's difficult to find bottom. When the market is in uptrend, in rally attempt and you are getting follow through day, you are getting strong action in leading stocks. With leading stocks, I mean stock which are delivering, industry leading profit margin, industry leading revenue and sales, revenue and profit growth. If I have to name few leaders in FMCG, I would name say Britannia is there. In banking, HDFC Bank, IndusInd Bank is there. In auto, we have Escort, we have Maruti Suzuki. So these are market leaders. So once the market comes from correction into rally, from say bear market to bull market, during that time you will see these all stocks will be the first one to come into the limelight. You will see strong action in these stocks. So, there you can identify the bottom. And the second thing is, okay, one more thing, that be assured if you're following our status, our calculations of market direction, you will be the first one to know when the market is into the correction or when the market is into the rally. Because right after 2016 demonetization phase, when the market were into the correction, we were the first one to tell to the world that we are into the correction, kindly sell the stock. And in February 2017, when the market entered into rally again, we were the first one to say that the market is in confirmed uptrend. You can go ahead and buy the stocks. People during that time, they were still skeptical. They started buying from April 2017. On the other hand, we started buying in the month of February. So February to April, we generated a hell lot of return, and that's the reason our return, shoot to almost 80% in 2017. In similar fashion, in 2018, when the market entered into correction in February, we were the first one to tell everyone that we are into the correction. Please sell your stocks. And that's the reason we sold our stocks and we are sitting just at a loss of 20%. I am saying 20%. We are very happy that we were able to cut our portfolio loss at 20%, because if you see top mutual funds in India, they are down heavily. They are heavily down. So just because they were not able to sell the stocks, they were not timing. The timing was very bad. Uh, there's a question from Ridul. I am not sure whether you will be able to get this presentation for. Okay, yeah, we are recording it. We are recording it. We'll send you for the future reference. I hope it will help you. Cool. So this is a quote by William O'Neill, that what seems too high and risky to the majority generally goes higher, and what seems low and cheap generally goes lower. Now, stock market is basically the game of market sentiments. If people are thinking that basically if the stock is rising up, that means the more people are buying that stock rather than selling. Go with the flow, buy the stock, and just get one thing out of your head. This will come up when you will build your career into equity research, when you will turn into a fund manager going forward. Don't try to focus on multi-baggers all the time, because it's difficult to identify a multi-bagger stock. And the second wrong thing is, stop thinking that a penny stock can only be a multi-bagger stock. I'll give you a lot of examples. We picked a lot of multi-baggers in 2017, and I'll tell you the price of those multi-baggers were above 400 rupees when we identified it. So that's what it was. It was 400 rupees, and it went up till it gave us a return of 250% in 2017. And the stock I'm talking about is Minda Industries. We identified the stock way back in February 2017. It was trading at 425 levels. Minda has a stock split, so you might not be able to go back and check it. I mean, you need to check the split ratio and recalculate it. It gave us a return of 250 to 280%. VIP Industries we picked up way when it was at 275 levels, but then we could only add it when it crossed 400 levels because of our strategy. So we missed that 200 rupees gain, but it's pretty okay, because from 400 we were able to sell the stock at 630 for 700 levels. So we are happy with that, because we were following the rules. On the other hand, if so this VIP was a stock particularly which I founded it, I personally liked it. So I'm telling you, I might have holded that stock in my personal portfolio, or I would have recommended it to my friend. But for the canceling portfolio, we could only add it when the stock breaks out. Now here I am telling you the key of the canceling. So the breakout is basically when the stock is crossing its all-time high price on above average volume. So this is called the breakout, and I might sound a bit weird now because I'm asking you to buy this stock at an all-time high. But yes, that's the strategy all about. It's a growth with momentum strategy. Buy the stock when it is breaking out, when it is crossing its all-time highs, because always remember that if a stock is crossing its all-time highs and the volumes are very high on it's more than the average, that means there is a lot of funds buying the stock, and the fund will only buy the stock when there is a subsequent change in the fundamentals of a company, or there is something new about the company which would unfold over the next 4 to 8 quarters, which they think they will hold for next 4 to 8 quarters, and they are expecting a return of, say, they are basically very bullish on that stock, because it takes a lot for a stock to cross its all-time highs. You might see that all-time highs is normally a resistance. So technical analysts would, pick up a stock at support and sell it at resistance. So that generally that's a selling point. However, we are asking you to wait. If the stock crosses that pivot, that all-time high is called the pivot, that time you buy the stocks. It's a proven rule. It's a pretty old company, and we have back tested it over the last 100 years. Canceling is a proven strategy. Kindly do not annotate on the, yeah, on the screen. Yeah, I'll just disable. Okay. So that's where we say we ask you to buy the stock when it is breaking out. So VIP did not break out at 275, that level. It could only break out when it crossed 400 levels, and that's the time we could only add it. So I was knowing that this stock would go up based on my conviction about this stock, based on my study about its fundamentals, its growth story. I knew that VIP Industries is a multi-bagger stock. Even now, I'm very bullish on that particular stock. So, but we couldn't buy it because William O'Neill says that wait for the breakout. We waited for the breakout. We were happy to make gains, and I would tell you, identifying VIP at 275 the rally from 275 to 400 took a lot of time, but from 400 to 650 rupees it gave us that kind of a return in 50-60% return in a very short span of time. So rather than blocking your capital, in the meanwhile I would have made 40-50% in another stock where I was holding VIP from 275. Now that's a thin line of difference between a value investing or a long-term view and a short-term or intermediate-term view. Let's not get into that detail right now. Okay. Again, a conventional approach is buy and hold blue chip stocks. We say that hold a leader for the price run and then sell. So when I was giving you the examples of blue chip market leaders, that SDFC Bank, IndusInd Bank, Maruti, I was not telling you that names because those were blue chip. I was just telling you because those are leaders. There is a difference between a blue chip stocks and a market leader. In luggage segment, VIP is a market leader because it is displaying an industry leading revenue and earnings growth as well as profit margin growth. But there might be other companies like you have Safari, they might have a better market capitalization, but they are not market leaders. Again, when you come to FMCG, we have a lot of companies: Nestle, Britannia, Hindustan Unilever, Colgate Palmolive, United Breweries. There are a lot of companies in FMCG, ITC. Then if you go by the market capitalization, ITC is the blue chip company, but just see the returns ITC has given. From the last 5 years, it is just flat. So, my ITC is not at all a leader. In fact, it's a laggard. It has been a laggard in FMCG. On the other hand, a company whose market share is less, like Nestle, Britannia has been the market leader over the last 5 years. It has given the maximum return. It has created wealth. On the other hand, companies like ITC have destroyed uh, wealth for investors in FMCG sector. Having said that, don't take it as my view that ITC is a bad stock or Britannia is a good stock. I'm just giving you an example, just telling you what has happened. And for a matter of fact, a leader's average run lasts for 12 to 18 months. So that's the reason I tell you that there's nothing called long term or short term, because the market leader mostly will run for 12 to 18 months. So 1 to 1.5 years it will run and it will give most of the returns. So if a stock is, you might have a classic example of Graphite India and HEG. Almost 1 year, 1.5 years, the stock has been rallying. Now you could see a lot of weakness in the stock. So for 1.5 years, this particular stock gave most of the returns in its life. However, I know people, even my seniors, who covered this stock, Philips Carbon Black, way back in 2008. They gave the interview in CNBC in 2008 that the target will be this much in 4 years, 5 years. But what happened from 2008 till 2017? The target was, sorry, in 2018. Philips Carbon Black was recommended by my senior at the levels of, say, I think 80, 90 rupees in 2008, and he gave a target of 1500 rupees in the next 4 to 5 years. On the other hand, we being a growth investors, we entered right in 2017 when the rally started. So, in just 1 year, we were able to get that target. However, on the other hand, someone who is holding the stock for long term is holding from 2008, just blocking his capital. So that's the time. That's the reason I'm saying that timing is very important, and the leaders average run lasts from 12 to 18 months. That's the average run. So don't think that, keep on balancing your portfolio. Just one stock for 5 years, you know getting by what mutual funds are doing is very difficult, because mutual funds by regulations are, they have to hold a minimum percentage of holdings in some of the companies. So they cannot sell, they cannot buy. So all those things, the restrictions are there in mutual funds. But you being a owner of a PMS in future or a hedge fund in future, you don't have those kind of restrictions. I hope I'm audible. Still, I'm getting. I think Rahul, there is some